The signals coming from global markets right now are impossible to ignore. When you look beneath the surface, you see a transition unfolding, one that most investors are still underestimating. Gold and silver are not just reacting to the moment, they are responding to a deeper structural reset in the global financial system. And that's why this is the final warning before the big move. The catalysts are accelerating, the data is aligning, and the window to position early is narrowing. What we're seeing right now is a convergence of macro forces moving in the same direction. Central banks are accumulating gold at the fastest pace seen in modern history. This isn't speculation, this is policy. When the institutions responsible for managing global reserves shift aggressively toward hard assets, they're sending a message: long-term confidence in fiat currency stability is weakening. And historically, when central banks lead a buying cycle, gold doesn't just rise, it re-rates. It enters a new price range entirely, driven not by emotion, but by necessity. Silver, meanwhile, is experiencing a dual surge, one part monetary, one part industrial. The industrial side is the most misunderstood. As the world accelerates toward electrification, solar expansion, advanced electronics, and energy transformation, silver is becoming one of the most strategically indispensable metals of our era. Demand isn't simply cyclical, it's exponential. It's tied to technological adoption curves, not consumer sentiment, and once adoption curves bend upward, they rarely reverse. On the supply side, both metals face real constraints. Silver is already in a multi-year structural deficit, and mine production is not keeping pace with industrial growth. Even a modest acceleration in demand can put extreme pressure on available supply. Gold, on the other hand, is not scarce, but new discoveries and new production are increasingly expensive, increasingly complex, and increasingly slow. We are operating in an environment where supply cannot easily respond to surging institutional interest. That imbalance is the spark that ignites long-term upside. The geopolitical landscape is another catalyst accelerating this shift. When trade routes are unstable, when currency alliances shift, when policy becomes unpredictable, capital seeks certainty. And throughout history, when uncertainty becomes systemic rather than temporary, capital flows toward gold and silver with conviction. We're not witnessing temporary volatility. We're witnessing a global realignment of risk perception. Precious metals tend to thrive in moments like these because they offer something no other asset can: independence from political systems, monetary regimes, and national policies. What's remarkable today is how early we still are. Despite headlines, public sentiment remains divided. Many investors are distracted by short-term noise, rate cut narratives, temporary corrections, market optimism. But the underlying structural demand is strengthening quarter after quarter. And once the breakout becomes obvious, the biggest gains will already be behind us. That's why being early matters, not because of fear, but because of positioning. Look at how technology disruptions unfold. The adoption curve starts quietly, builds gradually, then accelerates violently when mainstream recognition kicks in. Gold and silver are following a similar pattern right now, not in technology, but in global capital flows. Early signals are clear, measurable, and confirmed by institutions. The acceleration phase begins when confidence shifts from scattered investors to broad markets, and historically, that shift happens fast. Today's warning is not about panic, it's about clarity. The opportunity is asymmetric. Downside risk is limited. Upside potential is considerable, and the most powerful returns tend to emerge from moments when the majority is still unconvinced. Gold and silver are entering an era defined not by speculation, but by structural necessity. The forces driving this shift, monetary uncertainty, industrial transformation, and geopolitical realignment, are not fading. They're compounding. This is the last quiet moment before a very loud move, and those who understand the direction of long-term capital cycles will recognize why this window matters. The stage is set. The trend is established, and the catalysts are accelerating. The question now isn't whether gold and silver will move, it's whether you will be positioned before they do. Right now, the dynamics in the gold and silver markets are shifting faster than most investors realize, and the time to act isn't tomorrow, it's today. The reason is simple: when macro forces, supply constraints, and technological demand converge, assets don't just move, they explode. And that's exactly what's lining up for gold and silver. First, let's talk about gold. You've got central banks around the world increasing their purchases, treating gold less as a boutique hedge and more as core portfolio insurance. At the same time, the US dollar is showing signs of fatigue, real yields are under pressure, and uncertainty in global trade and fiscal policy is rising. These are the classic tailwinds for gold. When confidence in fiat weakens, gold's role strengthens. One respected consultancy forecasts the average price of gold could reach over US dollar 560/Oz in 2026, with upside toward US dollar 50/Oz. Investing News Network INN +2 Mining Weekly +2. That's not speculative fluff, those are data-driven projections grounded in flow dynamics and institutional allocation shifts. Now silver, this isn't just gold's little sibling. It plays a dual role: monetary metal and industrial metal. Solar panels, electronics, EVs, photovoltaics, all driving incremental silver demand. Meanwhile, supply is constrained. Silver is often a byproduct of base metal mining, and ramping production simply isn't fast or easy. According to analysis, silver is expected to hit an average of US dollar 57/Oz in 2026 and potentially move toward US dollar 60/Oz. Mining Weekly +2 Investing News Network INN +2. That kind of price move isn't just upside, it's a statement of structural re-rating. Here's the catch: when assets reach the point of broad awareness late, comers get what early movers leave behind. The moment when everyone says, "Oh, I should have bought," is often the moment the real run begins or ends. Right now we're between the quiet and the roar. The tectonic plates are shifting, but most portfolios haven't realigned. For those who adjust ahead of the surge, the reward is disproportionate. What must be understood is that this isn't just about safe havens and fear hedges. It's about rational allocation in an environment of complexity. With inflation pressures still persistent, geopolitical friction mounting, fiscal deficits growing, and currencies under pressure, gold and silver become more than reactive, they become strategic. And when you layer in silver's industrial upside, you get a bonus dimension, not just value preservation, but value creation. Momentum is visible, investment flows are increasing, physical demand is strong, structural deficits are being documented. The market is starting to recognize what's been building beneath the surface. What hasn't caught up yet is the full spectrum of allocation strategies among diversified investors. That means the opportunities still exist, but the window is shrinking. So if you haven't considered gold and silver seriously yet, now is the moment to examine how they fit into your portfolio. Set meaningful allocations, enough that if the metals perform, your portfolio participation is real. Stay agile in how you think about entry, growth, and risk. Track the macro signs, currency moves, real yield trends central, bank flows, supply data, industrial demand, those are your levers. This is the moment when staying on the sidelines is a luxury that becomes regret. The market won't wait for you when the next leg up begins, not if, but when. The pain of hesitating will be much stronger than the risk of acting. The stage is set for gold and silver to move in unison, propelled by fundamentals, not hype. And those prepared will be ahead. Right now, the alarm bells are ringing. The momentum behind gold and silver is building in a way that can't be dismissed, and the window to act is closing fast. What we're observing is a perfect storm of structural demand, constrained supply, and shifting risk perceptions that together point to a very distinct inflection point. If you're watching, yes, there's still time, but time is not on our side for long. Let's start with gold. Investment demand is surging as uncertainty mounts. In Q3 of this year, total gold demand reached a record high of over 1,300 tons, marking a 3% year-on-year increase and driving the value of demand up 44% compared to the same quarter last year. World Gold Council +1 central banks remain active, strategically buying and reinforcing their positions, which has the effect of elevating gold's status from hedge tool to foundational asset. State Street Global Advisors +1. Meanwhile, the global supply side is responding only modestly. Mined output is forecast to rise by just 1% this year, underlining how even incremental demand can put outsized pressure on available metal. Mining Weekly +1, because the engine driving gold is not speculative, swings its deep structural repositioning. The market has a heightened sensitivity. Once the narrative shifts, the move becomes much less about timing and much more about execution. Now silver, this is where the urgency gets amplified. Silver is wearing two hats. It's part precious metal, part industrial metal. That dual role gives it a unique leverage. Industrial demand, especially from solar panels, electric vehicles, electronics, and renewable infrastructure, is skyrocketing. MMT-C, PAMP +1 at the same time, the supply side is constrained by fundamentals. Much of silver is produced as a byproduct of mining other metals, so it doesn't ramp up quickly even if prices soar. Crux investor. COM +1, the result, a structural supply deficit is deepening, inventories are under pressure, and the price consequences are already showing up in the market. European Business Magazine +1 in both metals, the lever of safe haven flows is engaged. Macroeconomic uncertainty, currency debasement risk, trade friction, and monetary policy shifts all funnel capital towards tangible assets. When conventional assets look shakier, the appetite for gold and silver rises, and I'm seeing that appetite becoming more broad-based. World Bank blogs +1, the combination of that capital shift plus real demand growth, especially in silver, means we aren't just talking about a rebound, we're talking about a cycle. Here's the urgency. For many investors, the signals are still subtle, not yet screaming. But markets have a bias for surprise on the upside once the conditions align. When institutions, not just retail, begin to accelerate allocation, the move often becomes self-reinforcing. Being early means absorbing lower prices, fewer regrets, more optionality. Waiting means you may be chasing, buying at the top of the move, and that's a dangerous position. Crucially, the decision is not binary: buy now or regret forever. It's about positioning ahead of the large market recognition. Deploying capital thoughtfully, allocating with conviction, tracking the indicators that matter: official sector flows, inventories, supply updates, industrial consumption. These are the actionable levers. And right now they are flashing green. The window is still open but closing. The structural shifts are not distant. They are here. When the move accelerates, it will do so quickly and with little mercy for those who hesitate. Evaluate your positioning, act with clarity, avoid emotional reactions, and recognize that what we're witnessing isn't just a rally, it's a paradigm moving into motion. The dynamics shaping the gold and silver markets today are unlike anything we've seen in decades. The forces driving these metals are converging simultaneously: macroeconomic uncertainty, structural supply constraints, and transformative industrial demand. Each factor on its own is powerful, but together they set the stage for a potential explosive move. Investors who recognize this alignment now have a rare opportunity, because once momentum builds, the window to act compresses quickly. Consider gold first. Central banks across multiple continents are actively increasing their holdings, signaling a strategic shift in reserve management. This is not short-term speculation. It's a long-term recalibration of how institutions perceive risk and value. The global monetary system is under pressure. Inflation persists, real yields are low, and currency fluctuations are increasingly unpredictable. In such an environment, gold becomes more than a safe haven, it becomes a core asset for stability and confidence. Historical patterns show that when central banks accumulate aggressively, gold's price tends to re-rate higher, often rapidly, reflecting not just investor sentiment but fundamental allocation shifts. Silver presents an even more compelling case. Its story is dual-faceted. It is both a precious metal hedge and an essential industrial input. The industrial demand is particularly noteworthy because it is structural, not cyclical. The global push toward renewable energy, electric vehicles, and high-tech electronics is creating a surge in silver consumption that far outpaces historical norms. Meanwhile, mining supply growth remains modest and often struggles to keep pace with rising demand. This imbalance between industrial consumption and constrained production sets up a scenario where silver's price is poised for significant upward pressure, particularly as adoption curves in solar energy and technology accelerate. Supply-side dynamics cannot be overlooked. While gold's new production is gradually increasing, the pace is slow and expensive, with fewer high-yield discoveries each year. Silver's situation is more acute. Deficits have persisted for several years, and even a modest spike in demand can tighten the market dramatically. Structural shortages, coupled with growing global demand, create the ideal conditions for a pronounced price surge. The markets are beginning to reflect these fundamentals, but the full impact is still ahead, giving early movers a clear advantage. Geopolitical and economic uncertainty further amplify this opportunity. Global trade tensions, volatile policy decisions, and shifting alliances create an environment where confidence in traditional assets wavers. In such conditions, capital gravitates toward assets that are universally recognized as stores of value. Gold and silver are uniquely positioned to absorb these flows because they provide not only protection against volatility, but also leverage for growth as systemic risks materialize. Another important element is timing. We are currently at a point where early signals are evident, yet the broader market has not fully priced in the convergence of supply constraints, industrial demand, and institutional accumulation. This is the phase where informed participants can act strategically before the masses recognize the momentum. Once the wider market catches on, prices often accelerate sharply, and the opportunity to enter at favorable levels diminishes. This scenario is not driven by hype, but by observable trends and structural data. Investment flows into gold and silver, backed instruments are rising, physical demand remains robust, and deficit patterns are well documented. The stage is set for these metals to respond in a pronounced way, as they have in past periods of systemic stress and technological expansion. For those willing to analyze and act decisively, the alignment of forces suggests that gold and silver could experience significant upward movement in the near term. The message is clear: the conditions for a major rally are not theoretical, they are measurable and actionable. Investors who understand the structural underpinnings, recognize the accelerating industrial demand, and track central bank behaviors can position themselves to benefit. Timing and decisiveness are critical because once the market fully internalizes these forces, the surge in gold and silver prices could be swift and substantial, rewarding those prepared to act today.